Now it says the following exhibits on the left hand side of the screen. The following exhibits on the left hand side of the screen provide information relevant to the question. Hav company, there is this background information. Strength company, information about a strength company and acquisition target. Then financial information. Then there is this financial information. And furthermore, the acquisition proposals, the details of the three suggested. The details of the three suggested acquisition methods. The information should be used to answer the question requirements within your chosen response options. Now, what is the background information about Hav company? Let's just see. It says Hav company is a publicly listed company involved in the production of highly technical and sophisticated electrical components. Highly sophisticated and technical electronic component for complex machinery. It has a number of diverse and popular products. It has a number of diverse and popular products and an active research and development department. Significant cash reserves and a highly talented management who are very good in getting products to market quickly. Now, so what is it? It says Hav company is a publicly listed company involved in the production of highly technical and sophisticated electronic components for complex machinery. So that's what a bit of a background of this is. It has a number of diverse and popular products. It has a number of diverse and popular products and an active research and development department. So there's an active research and development department that they have. Significant cash reserves and a highly talented management who are very good in getting the products to market quickly. A new industry that Hav is looking to venture into is biotechnology, which has been expanding rapidly, and there are a strong indication that this recent growth is set to continue. However, Hav company has limited experience in this industry. What is it? Hav company has got limited experience in this industry. Therefore, it believes that the best and the quickest way to expand would be through acquiring a company already in the industry. So they wish to enter into the biotechnology industry. I repeat, they wish to enter into biotechnology industry. Now let's talk about the Strand company. It says the Strand company is a private company operating in the biotechnology industry and is owned by a consortium of business angels and company managers. The Strand company is owned by a consortium of business angels and company managers. The owner managers hire highly skilled scientists who have developed a number of technically complex products, but have found it difficult to commercialize them. So they are technical people, but they have found it difficult to commercialize them. They have also been increasingly constrained by the lack of funds to develop their innovative products further. So they also have had lack of funds to develop their products further. Discussions have taken place about the possibility of a Strand company being acquired by Hav company. A Strand company's management have indicated that the consortium of owners is happy for the negotiation to proceed. That the consortium of the owners is happy for the negotiation to proceed. If a Strand company is required, it is expected that its managers would continue to run the Strand company part of the larger combined company. Strength company is of the opinion that most of its value is an intangible asset. So what is the strength company saying? It says that majority of our value is in the intangible assets. Majority of our value is in intangible assets. Now, comprising intellectual capital. So usually what happens is, this thing happens with the biotech industry, that this is something that actually happens with the biotech industry, that they are majorly having the intangibles. I repeat, they are actually having the intangibles. That's the major thing that they have. Now, therefore, the premium payable on acquisition should be based on present value to infinity of after-tax earnings. The premium payable on acquisition should be based on the present value to infinity of the after-tax earnings the company has generated in the past 3 years over the average return on capital employed of the biotech industry. Now, this is an important area. And what I'll do is that I would highlight it with a different color just to make sure that you people know that this is something about a bit different thing. So this is how the premium is expected to, this is what they want, that this is what, this is the method that this should be used to pay the premium to them. Now, it says, however, Hav company is of the opinion that the premium should be assessed on synergy benefits created by the acquisition of the changes in the value due to changes in the price to earning ratio before and after the acquisition. So now there is actually a bit of a dispute about how I repeat, there is a bit of a dispute about how this specific synergy benefit should, this premium should be established. There are actually different opinions, there are different viewpoints about how this should actually be established. So what we would be doing now is that we would be seeing that what is the next part. Next part is about the financial information. It says given below are extracts of financial information for Hav company for 2003 and Strand company for 2001, 2 and 3. So earning before tax, the non-current asset, the current assets, share capital, reserves, non-current liability, current liability, they are provided. Now, the current average P ratio of the biotech industry is 16.4 times. And it has been estimated that a Strand company's P ratio is 10% higher. What I'm doing right now is that I have copied this information and I have put it here. I'll just pick out the key information from here. The current average P ratio is 16.4 times. Strand's P ratio is 10% higher than this. The P ratio of the combined company would fall to 14.5 times after acquisition. The annual after-tax earnings will increase by 140 million due to synergy benefits. The annual after-tax earnings will increase by 140 million due to synergy benefits resulting from the combination of two companies, from combining two companies. Now, both companies pay tax at 20% per year. And Strand's annual cost of capital is estimated to be 7%. Hav's current share price is this biotech industries Pre-tax return on capital employed is this. Now what next is there? Let's talk, let's discuss. Now we need to see what are the different acquisition proposals. It says Hav company has proposed to pay for the acquisition using one of the following three methods. So a cash offer plus share offer, a cash offer plus convertible bond, etc., etc. So this is the offer that has been made. Now, the requirement of this question is distinguish between the different types of synergies and discuss the possible sources of synergies based on the scenario. So among the different types of amongst the different type of synergies are as under. Number one, revenue synergy. Number two, cost synergy. And the third one of them is financial synergy. The revenue synergy is basically when each of the business benefits from the increase in the sales because of the, when each of the business benefits from the increase in the sales because of the other business. This could be through cross-selling, greater market share, ability to control prices, etc., etc. Now, what was Hav company all about? So that is one of the one. This cost synergy is basically the cost savings that arise because of the merger and acquisition. This could possibly be because of the ability to operate with economies of a scale in the present circumstances. The cost could be saved by eliminating duplicational functions and by having greater bargaining power when negotiating with the suppliers. The financial synergy is basically the financial impacts, including reduction in gearing, the tax savings, the additional debt capacity which could arise from the so in the present case, what is actually happening is that a strength company has relatively lower gearing as compared to Hav company, and the overall gearing of the business could reduce due to strength companies lower gearing. So basically these are the different types of synergies that could arise. If any one of you would like to add up anything, please go ahead. You're most welcome to add. Yeah, anyone would like to add anything to it? Okay. Now, so there is an additional thing, which is that the offsetting of the tax losses. Yes, that could also happen. The offsetting of the tax losses could also happen. Yes, that could also be there. Now, what next is there? The second requirement is based on the two different options expressed by Hav company. An Escribir company calculate the maximum acquisition payable, premium payable in each case. So what is it that you need to do? Based on the two different, based on the two different opinions expressed by Hav company and Escribir company, calculate the maximum acquisition premium payable in each case. Now, let's just try to see that what could be the different premium that would be payable. So case number one is that amount of premium required to be paid shall be determined as under. So in one of the cases it says the present value to infinity of after tax excess earning. A very important point is excess earnings. The company has generated in the past 3 years over the average return on capital employed of the biotech industry. The second one of them is the premium should be assessed on synergy benefits created by the acquisition and the changes in value due to changes in the price and earning ratio. The second option is it should be based on synergy benefits created by the acquisition. Synergy benefits created by the acquisition and the changes in value due to the changes in the price to earning ratios before and after the acquisition. Now, what is it that we need to do? I repeat, what is it that we need to do? We need to perform the calculations here. Let's just try to calculate. Premium payable shall be determined as under. So the premium payable shall be determined as under. Now, from the perspective of Hav company shareholder, from the perspective of the Have company shareholder, what is actually going to happen is that um, okay, now let's just try to see how it is going to be calculated. See, try to understand the earning before tax 397, 370, 352. Earning before tax 397, 370, 352. 370, 352. So how is this premium going to be paid? Present value to infinity of the after tax excess earnings. The company has generated in excess. The company has generated in the past 3 years over the average return on capital employed of the biotech industry. So what is the situation available about the biotech industry? Are we being provided anything about the biotech industry? Yeah, are we being provided anything about the biotech industry? It's a current average P ratio, the annual after tax earnings, so and so, so and so. The biotech industry's pre-tax return on capital employed is currently estimated to be 20% per year. The biotech industry's pre-tax return on capital employed is currently estimated to be 20% per year. So what is the capital employed? You need to calculate the average capital employed. You need to calculate the average capital employed. How do you do it? 2003, 2002, 2001. 2003, 2002, 2001. How would you do it? You would say the equity plus non-current liabilities. The equity plus non-current liability. How would we have the equity? It's 300 plus 183. It's 300 plus 183. Then what happens is that the next one of them is 300 plus 166. Then what happens is that there is this 300 plus 159. So you've got the equity for each one of them. Now, what is the non-current liability? 400, 400, 400. So the total capital employed, is what? The total capital employed is what? Is this plus this. This is the total capital that has been employed. So what happens is that if you have to calculate the average capital which is employed, it is going to be the sum of all this divided by 3. Sum of all this divided by 3. So the return percentage, what is that return percentage? The return percentage is what? I repeat, the return percentage is going to be what? Let's talk about it. The return percentage, let's just talk about it. We are being told that the return percentage is 20%. So the return is going to be 20%. Now, what is the examiner telling us? He says that the return generated in excess of the average return on capital employed. After tax, the present value to infinity of the after tax excess earning the company has generated in the past 3 years over the average return on capital employed of the biotech industry. So there is this return percentage. Now we are going to see that this is the 3-year return, which is summed up like this, 1119. If I say what is the average, so the average is this divided by 3, 373. Now what happens is that the average return is 373. The return for the industry based on ROC percentage is this. The excess return is this. The excess return is this. The impact of taxation at the rate of 20%. So hence post-tax return is going to be this. Hence what happens is that the discount factor is to be incorporated. Now are we being provided any discount factor? 7%. 7%. So what happens is equivalent to 1 upon 7%. Hence the present value to infinity of the return is going to be this multiplied by this. So this is what it is going to be. So if there is a premium which needs to be paid on the basis of I repeat, if there is a premium which needs to be paid on the basis of the post-tax excess earnings, then it has to be 2275. The post-tax excess earning, then it has to be 2275. Okay. Now, what is the next approach to calculate this premium? So the next approach to calculating of the premium is we did write down synergy benefits created by the acquisition and the changes in value due to changes in the price to earning ratio before and after the acquisition. So The current average P ratio of biotech industry is 16.4 times. And it has been estimated that the trends P ratio is 10% higher than this. However, it is thought that the P ratio of the combined company would fall to 14.5 times after acquisition. 14.5 times after acquisition. Now, let's try to understand this. Based on the second method, the existing PE ratio is what? 16 into 1.1, 16.4 into 1.1. The revised P ratio is going to be 14.5 times. The revised P ratio is going to be 14.5 times. The reduction in P ratio is going to be 3.54 times. The earning before tax and then the tax expense and the earning after tax and then synergy. So earning before tax right now is 397. The tax is gonna be, the earning after tax is going to be this. The value of the business is going to be this into this. And this, the revised earnings would be like again the same thing, but there's actually gonna be a synergy benefit which is going to be incorporated. And the synergy over here is what is expected to be 140 million. Now, the additional value that is going to arise is this 905. So based on above, the maximum premium that can be paid is, the maximum premium that can be paid is 2275.81. The maximum premium that can be paid is 2275.81. Is that okay now? So what have we done? We have actually been able to calculate the premium that is going to be paid, which is 2275.81. Now, next situation is, which is the last requirement. It says calculate the percentage premium per share that a strength company's shareholders will receive under each acquisition payment method and justify with explanation which payment method would be most acceptable to them. So you have to calculate the percentage premium per share. What is it? You have to calculate the percentage premium per share that a strength company shareholder will receive under each acquisition payment method and justify with explanation which method would be most acceptable to them. So what are the payment methods? Number one, a cash offer of 5.72 for each strength company shares. So how would we calculate? Calculating the payment premiums. Calculating the payment premiums are going to be like this. The first offer is going to be, albeit the first offer is going to be the first thing that you got to do is that you got to calculate the value of the combined company post acquisition. So what is it that you need to do? You need to calculate the value of the combined company post acquisition. So if you try to calculate the value of the combined company using post acquisition, so yeah, you can see the final part of the previous calculation here. Let me know when I can move. Yeah, let me know when I can move. Okay, thank you. Now let's move. So basically, you need to calculate the value of the combined company. Now the profit before tax, the profit after tax of a strength, the profit after tax of Hav, it's gonna be what? 1980, 397 into 0.8, and this is going to be 1980 into 0.8. So you sum up both of them, the combined PAT adds synergy benefits to it. So you've got 1 million. Expected PAT is gonna be this plus this. The expected PE ratio is expected to be 14.6, 14.5 times. And on the basis of this, the value of company is going to be what? The value of company is going to be this. Now, when I talk about the number of shares, so we have got 600 million as the capital, divide by the par value, which is 0.25, gives you 2400 million shares. Now the value of one share, the value of one share of combined company will be worth what? Will be worth this divided by this, gives you what? Gives you 12.33. Now, the examiner has asked us to calculate the gain under each of the situations. So what you would do is that he says that first acquisition proposal is that a cash offer of 5.72 for each strength company share. So value of each share value of each share, the cash offer of 5.72 for each strength company share. Do we have the strength company's current share price? Yeah, do we have the Strand company's current share price? Anywhere in the question, do we have the current share price of a Strand? Okay, you could calculate using this information which is available. The current share price of a Strand is going to be calculated like this. The PE ratio, which is 16.4 multiply 1.1 multiply by the earnings after tax. The value, number of shares per share value. The number of shares of a Strand are what? Is equivalent to 300 divided by 0.25. So per share value is this 4.77. Now in case number 1, the cash paid is 5.72. The existing value of the business is what? The existing value of the business is what? Is 4.77. So hence the gain is gonna be like this. So is he asking us to calculate the percentage premium per share? Yeah. Percentage premium is going to be what? This divided by this. So if I could just say this to be percentage. Now kindly check it and confirm to me that you all are okay with this calculation. Yeah, kindly please do check it and confirm to me if you all are okay with this calculation. Okay, let me explain to you with respect to it. Do you understand what have I done with respect to this Strand company's share price? Yeah, do you understand what I have done with respect to Strand company's share price? Okay, I'll just explain from the beginning. Now see, this is what we have calculated the value of a Strand company. 16.4 times is the industry average PO and your P is 10 times greater. And then multiply by your post-tax earnings. The number of shares are this. The value per share is going to be this divided by this. This gives you value for Strand company. Now what is the value of the combined company? This is the profit after tax of a Strand. This is profit after tax of Hav. You combine both companies PAT, you get this. You add synergy to it, you get the expected PAT. There the expected P ratio, which is this. The value of the combined company is going to be the multiple of these two. The number of shares in case if no shares are being issued is this, or I could just say that just ignore this because we can just do this calculation later on also. For the time being, let me know you do understand this. Yeah, do you understand this value? Yeah, do you understand this value? Okay, now let's just see. The second acquisition proposal is a cash offer of 1.33 for each strand company share plus one half company share for every two strand company share. Now see, what are you gonna do? You're gonna say the cash paid is 1.33. Value of strand company share, sorry, value of half company shared, half company share provided. So the value of the half company share was 9.24. The total provision is this. 10.57 is the total consideration that you have paid. The value of shares acquired is like this. You have got two shares of strand company. So the gain is gonna be what? The gain is gonna be this. And if you talk about the percentage premium, how would we get the percentage premium? Let's just try to see. It's just gonna be this divided by this 10.69%. Do you get it now? Okay, so I'm leaving the third calculation on to you people that you got to do it on your own.